and beginning our broadcast, many farmers in neighboring Iowa are trying to recover after a devastating storm earlier this week. On Monday, a derecho event packing winds of 100 miles per hour, the equivalent of a Category 2 hurricane, flattened crops in their fields, tore apart buildings, and collapsed grain bins. Officials estimate roughly one-third of Iowa's 30 million acres of agricultural land was impacted by the storm, with the middle part of the state being hit the hardest. Portions of northern Illinois and southern Wisconsin felt the effects of the storm too. In fact, we told you last week that Iowa State University's Lee Schultz would join us for our market segment today. Unfortunately, we had to reschedule with him due to the storm, but Darin Newsom of Darin Newsom Analysis is pinch hitting for us. He joined me on Wednesday after the release of the eagerly anticipated August WASDE Report to discuss what that means and how this weather event in Iowa impacts it.
That was probably the biggest thing of today, in that nobody's paying attention to USDA's report, which I like, that basically folks are ignoring it because they know the new crop production numbers are a joke, because they can't take into account what we saw happen Monday. And so there's just too much uncertainty about how much damage was done. The market will tell us in time. We've just got to give it a few days for it to start sorting it out. And then we'll see it in basis, we'll see it in spreads, and we'll see how it starts to register.
Historically, when events like this happen during the growing season and impacts, by early estimates, maybe about 10 million acres, how do the markets respond?
Historically, we would see, we would see the non-commercial side or the fund traders just jump in and run with this thing, particularly if we're talking about, hundreds of millions of bushels lost in a key state like Iowa. Here again, we're talking about the possibility of 10 million acres affected by this to varying degrees. But again, we're talking about hundreds of millions of bushels of corn, who knows how much soybeans. So in the past, we would see fund traders really jump on this and start to move. We don't see that as much anymore because there's more algorithm trade. Most of them aren't, they're not really based on headlines anymore. They've learned not to do that. So now we're waiting for momentum signals and all of these other things. To me, it's going to be more important as to what happens with the spreads, with basis, when we start seeing the commercial side come into play. If they start to get concerned, and if we start to see this carry, the little bit of carry that's in soybeans and the stronger carry that's in corn, start to get trimmed away, start to get cut, then we're going to see that there's some real concern out there about the possibility of tightening up supplies.
Darin, you mentioned earlier about this week's WASDE report and how the events of Monday already make a lot of that report old news. So that being said, what quick thoughts can we take away from Wednesday's report?
The quick thoughts that it was another waste of time, that we really don't even need these things. They came in, USDA came in something like 181 bushels per acre on corn. Well, that's fine. We've seen private estimates in the 182, 183 range. So, there really wasn't anything there. Production for corn, 15.2, 15.3, something like that. To me, the biggest thing was what happened with old crop demand. We did see corn exports increased a little bit. Everything else, all the other legs of demand were left unchanged. And soybeans, they left exports unchanged, and that's interesting to me. And that it still looks like we're going to come up short. We're going to have a big last few weeks here in August to get up to the 1.65 billion bushels USDA continues to talk about. And then looking ahead to new crop, USDA increased soybean export demand by 75 million bushels from the previous month. I'm not that bullish. I think they're overstating it a little bit. And despite that, we saw a sizable jump in new crop ending stocks again because production went up. So there's a lot of mixed signals right now in both new crop corn and soybeans, and I really feel like that's why the market in general just left it alone.
Let's pivot to the livestock markets now, and from everything that you hear, the processing slowdowns seem to be behind us. So have we gotten to a point in the cattle markets where we're approaching a bit of stability here in this third quarter?
From the news and headlines, it certainly seems that way. The market seems to be anything but stable right now because Fundamentally, I know the cattle demand, the demand for beef just isn't as strong as what it's supposed to be. I think we're looking ahead. Are we going to be short of beef? The cash market continues to go up, all while there's more concern about the unemployment number, the jobless claims that keep coming out. To me, it looks like the market in general right now is watching the stock markets rather than the economy, and we really have to emphasize those are two distinct things. The economy does not equal the stock markets. The economy's got some problems, and the stock markets are going to new highs. Right now, cattle market seems to be wanting to follow the stock markets, not unusual, and we see the cash market continuing to go up. I think we're going to hit a tipping point at some time. Future spreads still aren't bullish. We've moved, at least into the neutral range. If we look at the October, December, Feb's still a little bit bearish as we head into and look further out into the winter months. So I still think there's some concerns fundamentally for the cattle market right now. Just seems to be shrugging it off.
And for pork, concerns in that market as well?
Again, if we look at the export demand numbers, very strong. But if we look at our overall supply numbers, they're still huge. October Feb spread still bearish. This, again, is a bit of a concern to me as we head into the fall and winter. As long as we can keep that demand going, then I think the market's going to hold together relatively well. But it's tentative. And again, after the release of reports here in midweek, we saw some more commercial selling starting to emerge in the hog market. It's never a good sign, trying to build a rally off of while the commercial side is selling. So it's a bit of a concern again, because spreads remain bearish, supplies remain large. We're going to have to continue to see strong demand.
And finally today, could you leave us with any marketing or risk management advice for our livestock producers watching?
Yeah, starting with the cattle market, we're looking at the August Feb April contracts all moving to new highs for this rally here this week. What we need to do is keep a close eye on this. They're all sharply overbought, and so they could turn on a dime, particularly if we start taking the economy back in, building the economy back into the equation. So we want to be very careful there. We want to look for some hedging opportunities. We don't want to jump the gun, but we want to certainly look for opportunities or signals that these markets are starting to turn, these contracts are starting to turn. As for the hogs, it looks like, again, these, August Feb contracts just getting rolling on some uptrends on their weekly chart. So we may want to give them some room, but we have to be careful if the commercial side starts selling. If they start getting ahead of us in the hedging, we're going to have to jump in there and get some positions on.